Have you ever noticed that insurance companies operate in massive skyscrapers in every major city, rake in billions in profits every single year, and somehow manage to stay wildly profitable even after hurricanes demolish entire coastlines or wildfires burn through thousands of homes? Meanwhile, when you file a claim for a broken pipe or a fender bender, suddenly it's like pulling teeth to get them to pay what they actually owe you. So what's really going on here? How is it that insurance companies literally never lose? And more importantly, what can you do to stop getting played by a system that's rigged from the start? If you've ever wondered why your insurance premiums keep climbing while the companies keep posting record profits, or why filing a claim sometimes feels like going to war, make sure to hit that subscribe button, because by the end of this video, you're going to understand exactly how this game works and how to stop being the sucker at the table. Now, before we get into the specific tactics these companies use to separate you from your money, let me paint you a picture of just how profitable this industry really is. In 2021, property and casualty insurance companies in America actually lost money on their core business. They paid out more in claims and expenses than they collected in premiums. You'd think that would mean a bad year, right? Wrong. These same companies reported over $63 billion in profit. 63 billion. So how does a company lose money on its main business but still walk away with profits that would make tech giants jealous? The answer is something called float. And understanding this concept is like discovering the cheat code that explains the entire insurance industry. Here's how float works, and trust me, this is going to blow your mind. When you pay your insurance premium, let's say you write a check for $1,500 for your car insurance, that money doesn't just sit in a vault waiting for you to have an accident. The insurance company immediately takes that $1,500 and invests it. They buy stocks, bonds, real estate, whatever they think will generate returns. And here's the kicker. They get to keep all the investment profits from your money, even though it's technically supposed to be there to pay your claims later. This is the float. It's basically free money that the insurance company gets to play with, and if they're smart about it, which they absolutely are, they can make more money investing your premiums than they lose paying out claims. Warren Buffett built one of the largest fortunes in human history largely on the back of this exact mechanism. Berkshire Hathaway's insurance operations generate over $140 billion in float. Think about that for a second. That's $140 billion that doesn't belong to Buffett, but that he gets to invest however he wants and keep all the profits. It's like if your neighbor gave you $100,000 and said, hold on to this, I might need it back someday, but in the meantime, you can invest it and keep whatever you make. That would be an amazing deal, right? Well, that's exactly what's happening with your insurance premiums, except it's happening billions of times over across the entire economy. But here's where it gets even more interesting. Insurance companies don't even need to make money on their core business to be wildly profitable. They can literally pay out more in claims than they collect in premiums. And as long as their investment returns from the float are strong enough, they still walk away winners. This is why you'll see insurance companies stay in business even after catastrophic years where they're hammered with claims from hurricanes, wildfires, or other disasters. The float cushions everything. It's a built-in shock absorber that makes the entire business model nearly indestructible. Now you might be wondering, okay, that explains how they stay profitable, but how do they set prices in the first place? How do they know what to charge you for your policy? And this is where things get really sophisticated. Insurance companies don't just guess. They use something called the law of large numbers, which is a statistical principle that basically says if you collect enough data points, you can predict outcomes with scary accuracy. Sure, they have no idea if your specific house is going to burn down this year, but if they insure 100,000 houses just like yours, they can predict almost exactly how many of them will burn down. This converts what looks like gambling into mathematics. And here's the part most people don't realize. The bigger an insurance company gets, the more accurate their predictions become. This is why small insurance companies struggle and large ones dominate. When you have millions of policyholders, the randomness averages out, and you can price your policies with incredible precision. It's like flipping a coin. If you flip it 10 times, you might get 7 heads and 3 tails. But if you flip it 1,000,000 times, you're going to get almost exactly 500,000 heads and 500,000 tails. Insurance companies are just applying this principle to your risk of getting in a car accident or your house getting damaged. But let's talk about what really matters to you as a consumer, the claims process. Because this is where insurance companies make their money back on the other end, and it's also where they deploy some pretty aggressive tactics to avoid paying what they owe. The first thing you need to understand is that the insurance adjuster who shows up after your loss works for the insurance company, not for you. Their job is to minimize what the company pays out, period. They're pleasant, they're professional, they act sympathetic, but make no mistake, they are trained to find ways to reduce your claim or deny it entirely. One of the most common tactics is what I call the quick settlement trap. You have a loss, maybe storm damage to your roof or a car accident, and within days the adjuster shows up with a check. They act like they're doing you a favor, getting you taken care of quickly, but here's the problem. Accepting that check almost always requires you to sign a release, which means you're agreeing that this payment settles everything and you can't come back later for more money. This is dangerous because sometimes the full extent of damage doesn't show up right away. Water damage can lead to mold weeks later. Structural problems might not be obvious immediately, but once you sign that release, you're done. You've given up your right to claim anything else, even if you discover $10,000 worth of additional damage a month later. Another tactic is the recorded statement. After a loss, the adjuster will often ask to record a conversation with you about what happened. They frame it as routine paperwork, just getting the facts straight. But this is actually a trap. They're looking for inconsistencies or any statement you make that they can use against you later. They'll ask questions like, "How old is your roof?" Or "What do you think caused the damage?" If you guess wrong or speculate about something you're not sure about, they can use your own words to deny the claim. Maybe you say you think the roof was 15 years old, but it was actually 12. Now they can argue that you made misrepresentations on your claim. Or maybe you speculate that the leak was from wear and tear, and boom, suddenly it's not covered because wear and tear is excluded from your policy. The smart move here is to understand that you're generally not required to give a recorded statement immediately. You can decline or ask to provide a written statement instead, which gives you time to think carefully about your answers. And here's a pro tip: never speculate. If you don't know something for certain, say, "I don't know." Don't guess, don't estimate, don't try to be helpful by filling in blanks. Every word you say can and will be used against you if it serves the company's interest. Then there's the delay tactic, which is probably the most insidious. Insurance companies know that time is on their side. Every day they delay paying your claim is another day they get to keep that money invested and earning returns. For a large claim, delaying payment by even a single day can generate thousands of dollars in interest for the company. So what do? They request redundant paperwork. They switch adjusters mid-claim. They send reservation of rights letters that drag out the investigation. They create bureaucratic hurdles that slowly grind you down until you're so exhausted that you'll accept a lowball settlement just to make it end. This is sometimes called delay, deny, defend. Delay the claim as long as possible. Deny it if you can find any technicality. And if the policyholder fights back, defend it in court where you have vastly more resources than they do. Here's the reality. Insurance companies have entire legal departments. They have sophisticated software systems. They have decades of experience fighting claims. You're one person who's probably dealing with a claim for the first time in years. It's not a fair fight, and they know it. But there are ways to level the playing field. Document everything. Every phone call, every email, every conversation should be followed up with a written summary sent to the company. Create a paper trail. Set clear deadlines for responses. If they don't respond within a reasonable time frame, file a complaint with your state insurance commissioner. Most states have bad faith laws that penalize companies for unreasonable delays, and the threat of regulatory action can suddenly make your claim move much faster. Now let's talk about something that affects everyone, but almost nobody understands. Why do your premiums keep going up even if you never file a claim? The answer lies in something called catastrophe modeling. Insurance companies used to price policies based on historical data. If your area hadn't had a major hurricane in 50 years, they assumed it was safe and charged low premiums. But climate change has completely blown up this approach. Historical data doesn't predict the future anymore. A neighborhood that never flooded before is suddenly underwater because of changes in weather patterns. So the industry shifted to catastrophe modeling, which uses computer simulations to generate thousands of hypothetical disaster scenarios. These models can simulate what would happen if a Category 5 hurricane hit Miami, or if a 7.5 earthquake struck Los Angeles, or if wildfires swept through California suburbs. They estimate probable maximum loss, which is the worst-case scenario the company might face. And based on these models, they price policies accordingly. If you live in an area where the models predict high tail risk, which means low probability but catastrophic impact events, your premiums are going to skyrocket. This is why homeowners insurance in Florida has become basically unaffordable for many people, and why major insurers are pulling out of California entirely. The models say the risk is too high, so they either charge insane premiums or refuse to write policies at all. But here's the part that will really bake your noodle. Insurance companies don't even keep all this risk themselves. They transfer it to reinsurers, which are basically insurance companies for insurance companies. And increasingly, they're transferring it to the capital markets through something called catastrophe bonds. These are financial instruments that work like this. Investors buy the bonds and earn a high interest rate. But if a specific disaster occurs, like a hurricane with winds over 150 miles per hour, the investors lose their money and it goes to the insurance company to pay claims. If the disaster doesn't happen, investors keep earning their high yield. What this means is that your home insurance policy is now backed by hedge funds and pension funds around the world that are basically betting on whether or not your house gets destroyed. It's a weird system when you really think about it. Global capital markets are now directly connected to whether or not you get paid when your basement floods. This is how insurance companies spread risk so that even massive catastrophes don't bankrupt them. They've essentially outsourced the risk to the entire financial system. So now that you understand how the game is rigged, what can you actually do about it? How do you protect yourself in a system that's designed to extract maximum premiums while minimizing payouts? Let me give you some specific strategies that actually work. First, raise your deductibles. This sounds counterintuitive, but hear me out. Insurance companies charge disproportionately high premiums for low deductible policies because they know small claims are expensive to administer. Every time you file a $500 claim, it costs them more in overhead than the actual payout. Plus, filing frequent small claims marks you as a risky customer, which can lead to rate hikes or non-renewal. Instead, raise your deductible to the highest amount you can comfortably afford. Maybe that's $2,500, maybe it's $5,000. This will dramatically lower your premiums. Take the money you save and put it into an emergency fund. Now you're essentially self-insuring for small losses while still having protection against catastrophic events. This is smart risk management because insurance should only be used for losses you can't absorb yourself. You don't insure your phone for $50, you insure your house for $500,000. Second, understand exactly what's covered and what's excluded in your policy. Standard homeowners policies exclude flood damage, earthquake damage, and wear and tear. If you live anywhere near water or in a seismically active area, assume you need separate policies for those risks. Don't fall into the trap of thinking it hasn't happened here before, so I don't need coverage. Climate change has made historical patterns irrelevant. Also, look into endorsements for things like sewer backup and law and ordinance coverage. These are cheap add-ons that can save you tens of thousands in losses that would otherwise be excluded. Third, and this is critical, make sure your policy covers replacement cost, not actual cash value. Here's the difference. Actual cash value means they pay you the depreciated value of your stuff. If your 15-year-old roof gets destroyed, they pay you the value of a 15-year-old roof, which is almost nothing, and you're stuck paying the difference to buy a new one. Replacement cost means they pay what it costs to buy new today without depreciation. The premium difference is minimal, but the protection difference is massive. Always pay for replacement cost coverage. Fourth, document everything before a loss ever happens. I'm talking about creating a full video inventory of your home. Walk through every room, open every closet, film every item of value, zoom in on serial numbers, show the condition of your roof and exterior. Upload this to cloud storage. If you ever have a total loss from fire or hurricane, this video is your evidence. Without it, you're relying on memory to list everything you owned, and the adjuster will lowball you every single time. With video proof, they can't argue about what you had or its condition. Fifth, when you do have a claim, never accept the first offer. Treat it as a starting point for negotiation, not a final settlement. Get independent estimates from contractors. Push back on anything that seems low. Remember, the adjuster's first offer is designed to test whether you'll just accept it and go away. Most people do. Don't be most people. Here's something else most people don't think about. The insurance company often recommends preferred contractors after a loss. While this seems helpful, these contractors rely on the insurance company for volume business, which means they're incentivized to keep the insurer happy, not you. They might cut corners, use cheaper materials, or limit repairs to match the adjuster's estimate rather than what actually needs to be done. You have the right to hire your own contractor. Get multiple estimates. Make sure the work is done to your standards, not the insurance company's budget. Let's talk about what happens in the absolute worst case scenario. What if the insurance company completely denies your claim or offers an insult of a settlement? You have options. First, file a formal appeal within the company. Most insurers have an internal appeals process that escalates your case to senior adjusters. Second, file a complaint with your state insurance commissioner. Regulators have the power to investigate bad faith practices and can force companies to reopen claims. Third, consider hiring a public adjuster, which is someone who works for you, not the insurance company, to negotiate your claim. They typically take a percentage of the settlement, but if they can get you $50,000 more than you would have gotten on your own, giving them 20% of that increase is worth it. And in extreme cases, you may need to lawyer up and pursue a bad faith lawsuit. Insurance companies are required by law to handle claims fairly and promptly. If they violate these duties through unreasonable delays, denials, or lowball offers, they can be hit with punitive damages that far exceed the original claim amount. The threat of a bad faith lawsuit can sometimes be enough to get them to settle fairly. But here's the thing. The best defense is a good offense. The real strategy is to be so well prepared and knowledgeable that the insurance company knows they can't push you around. When you understand how their business model works, when you document everything, when you read your policy and know what's covered, when you push back on lowball offers, you force them to treat you seriously. You're no longer an easy mark. You're someone who will cost them time and money if they try to screw you over. And suddenly it becomes easier for them to just pay your claim fairly than to fight you. The insurance industry is never going to lose. It's built on mathematical certainty, backed by global capital markets, and protected by regulatory structures that ensure its survival even in catastrophic years. But that doesn't mean you have to lose either. By understanding the rules of the game, you can make sure you're not the one subsidizing their billion-dollar profits. You can optimize your coverage, minimize what you pay, and maximize what you get back when disaster strikes. Insurance is supposed to be a financial tool that protects you from ruin. Stop treating it like a grudge purchase and start treating it like the strategic asset it should be. Your future self, standing in the ruins of a disaster with a fair insurance check in hand, will thank you for it.